All right, we are recording. So just as a reminder, Professor Nguyen Yu, so you're an assistant professor at the University of Montpellier, and you're also the head of the Green Finance Diploma, which I think is important to you, and also important with regard to the presentation that you are going to do today. And you have a PhD in applied mathematics from University Paris Dauphine. And so today, as I mentioned, you will talk about finance, and more specifically, you will talk about the stochastic financial market module for the stock flow consistent models. So yes. The floor is yours.
Thank you very much. Thank you everybody for attending to this seminar, and thank you Gaël for the invitation. So my talk will be dedicated to a specific module, a model, dynamical model, representing financial markets. And the point is that I want to plug this model. This is not something that has been done yet, but I want to plug this model to the Goodwin-Kin model. And so I have some requirements. I have some preliminary hypotheses that I know of about how financial market works and what are the interconnection between the real macroeconomic sphere on one hand and the financial market behaviors on the other hand. First, I want to apologize for delaying the seminar of the previous week. Is because my first daughter, my third child, Aliénor, is born the 4th of January, and we had the seminar the 5th, so it was pretty difficult to present the next day. So apologies, and now I'm just being aware that she's going to be on the internet and on the YouTube channel of the Environmental Justice Program, which is something I wanted to avoid, but anyway, it's okay. It's just a picture. So this is her. So what is my my starting point? As I said,
we don't see the picture.
You don't see the picture. You don't see me changing the slides. Okay.
Yeah, I think you didn't choose the right screen to share, maybe.
Okay, let's update that. Let's update that. Hop. Partager. Is that okay now?
Yeah, that is okay.
Oh. Zoom s'est fermé de manière
It's interesting. We Zoom closed and it was still connected.
There had been a little bug with. Okay, let's start again. Okay,
yeah,
do you see my slide? It moves.
Yeah, that's perfect.
Oh.
So this is Aliénor.
Oh, wow.
Aliénor. Thank you.
Congratulations. Congratulations.
But she's not the point of the seminar. It's just the reason why I couldn't present my work last week. So the starting point of this presentation, it was requested by Gaël because he wanted to invite me to talk about this model I worked on for perhaps 4 or 5 years. Is the Goodwin-Kin model. The Goodwin-Kin model is the core model that can be extended with several modules that you are aware of, especially the climate module, perhaps RELAX, Say's law, and the understanding of money. The Goodwin-Kin model is a macroeconomic model. It's a macroeconomic dynamic. It's a dynamical model based on differential equations. It's a stock flow consistent model. And at first, Steve Kin purpose was to represent somehow a Minsky crisis, meaning a crisis of the economy due to the financial sector, mainly how the financial sector behaves. And mostly one of the focus of Steve Kin is that endogenous money creation by banks, the ex nihilo creation of money by banks, is one of the true genuine dimension that can destabilize the macroeconomic system. But we have studied this model quite extensively for more than a decade now, perhaps 2 decades. And what we know is that the original Keene model is neither really a Minskian model. There are many models that attempt to represent the ideas of Hyman Minsky, who has never formalized his thesis of the financial instability hypothesis. And the Goodwin-Keene model is not a model that represents correctly the complex, of course, it's very complex, but the complex dynamics of the financial instability hypothesis. And we have shown also with Antonin Potier that it does neither represent the endogenous money creation of banks. And for that, you need to relax Say's law, something that is very important that we've done with Mateusz Grasselli in 2018. An additional point is that this Goodwin-Keene model is only a macroeconomic model, which is used most of the time the case. Macroeconomic models do not provide a detailed representation of financial markets. But since a Minsky financial instability hypothesis is strongly relying on the behavior of financial markets, not only, but it relies on it, it is quite surprising that there is absolutely no financial markets in the model or in the several extensions later. There are financial markets in stock flow consistent models that you can find in Godley and Lavoie, in the Post-Keynesian economics, in their book. But otherwise, you don't have a detailed representation of financial markets in this model. And this is the purpose of my work the last couple of months and for the forthcoming months. So my presentation will be the following. Perhaps you're not accustomed to finance theory and theory of financial markets, so that I'm going to make a very, very fast crash course in dedicated to the post-Keynesian theory of financial markets, and in particular, a Minsky theory. Minsky is considered for post-Keynesians as a post-Keynesian, and especially the way final finance is detailed in post-Keynesian theory. Perhaps I'm going to express a little bit in the second time what are we supposed to assume reasonably about financial markets in accordance with post-Keynesian theory, because we will swim a little bit more into the theory of financial markets, and finance has been mostly monopolized by neoclassical economists and neoclassical finance guys. So perhaps it's an attempt of being picky and select the right assumptions and the right behaviors and the right facts, empirical facts, that we need for a suitable theory of financial markets to connect with the macroeconomy of the Goodwin-Keene model in particular. To do that, this is the main point of my presentation here, is to present to you a model that I have not invented, but I'm going to find very useful and very promising for the connection with the Goodwin-Keene model, is the Chiarella model of 1992, and it's a date by Majewski, Ciliberti, and Jean-Philippe Bouchot. And but the model itself is not exempt of flaws. And in the last time, I will have the time at the end to finish on that. I'm going to suggest some modifications of the model in order to make it stock flow consistent first, and then to make it dependent on some macroeconomic variables, so that the connection will be not artificial, but there will be real feedback between the macroeconomic on one side towards the financial markets, and from the financial markets to the macroeconomy. And so I'm going to finish with some forthcoming work to do, and because this work is clearly ongoing and absolutely not finished, as you will see. First, I'd like to insist on something that I didn't see much in in papers or when exchanging with the economists that are accustomed to stock flow consistent models, is that stock flow consistency is something that has many advantages. I think it's a really strong paradigm for macroeconomic modeling. Clearly, it's very ideal for having a clear overview of the economy that you want to model. It does not provide immediately the model that you want to write, but it clearly represents the economy and the institutions that you want to show in your model. So it's very, very neat, very nice and transparent. And I think it is actually ideal for an institutionalist representation, meaning that you can make appear some new class of population, new interactions, new regimes of interrelations between two classes. Of course, it ensures consistency. This is the main point of such tables that you can find in stock flow consistent work. It allows to write accounting constraints and equations, which help a lot in generating the reduced model or the extended model that you want to write at the end and simulate. But one of the points that I didn't find most of the time in this discourse of people who use that is that stock flow consistency allows to track very complex financial flows. Even neoclassical models, the simplest one can be stock flow consistent. It's just that they are not incompatible. They are not explicitly stock flow consistent, but sometimes they are not incompatible with that. But if they are not incompatible, it's because they are very simplistic and very unrealistic. When they are more complex, suddenly the more you add assets, and especially financial assets and quantities in the model, and the more likely it is that the model is stock flow inconsistent when you have a mainstream model. So with the post-Keynesian stock flow consistent model, and I say post-Keynesian, but stock flow consistent is much larger paradigm than the post-Keynesian. In particular, it's compatible with ecological economics. It allows to track very complex financial flows, and you can see that people can buy some equities, they can buy some commodities, they can buy some currencies, and they can exchange and make a very complex portfolio, and you ensure that all is tracked in the table and that you don't have mistakes and misspecifications, which is very convenient because it can be very complex when you add assets. This is a table from Godet and Lavoie, and you can see that you can have money, you can have bills. Bills are short-term maturity bonds or treasury T-bills, usually the US T-bills, and you have bonds which hold on several on longer maturity, longer horizon, and eventually you can add equities of bank, equities of firms. You can have perhaps commodities or currencies and so on and so on. So it can be very complex, and you have to ensure that everything is coherent. So this is one of the main points of stock flow consistency, is that it allows complex financial flows and how to manage portfolios. I tried to summarize very shortly the main key messages of post-Keynesian position toward finance and financial markets. I think one of the main points to understand is that they make the distinction, and it's a very crucial distinction between initial and final finance. So initial finance is the finance that you invoke when you want to find money to invest in tangible assets. How do you build the required amount of money in order to invest in tangible assets, or perhaps sometimes in financial assets, so that you are looking at endogenous money creation, credit. You are looking at savings and own funds. And the final finance is the more accustomed view of finance from the mainstream current, is only the allocation of excess savings, meaning that the money is already here, and final finance is dedicated to understanding why and how people make the choice of investing in some specific assets and to sell some others. So neoclassical finance does not distinguish initial and final finance because they don't have endogenous money creation. And they mostly focus on final finance, meaning that they look at optimize the portfolio allocation and this kind of stuff. And it's clear that for Steve Keen, finance means initial finance. It's endogenous money creation, and it's how people with this new purchasing power created by bank, they can destabilize the economic system. But final finance is also important and something that is also studied partially in stock flow consistent models, notably by Godley and Lavoie. So that I want to do is to show you a model of final finance in order to plug it with the Goodwin-Keen model. So very quickly, of course, there is this endogenous money creation that grounds economic dynamics in post-Keynesian economics. The role of banks and monetary authorities are very different than in the mainstream. It is shown that even shadow banking strongly depends on endogenous money creation. I strongly advise to read the very recent PhD thesis of Rudy Bugeli under the supervision of Marc Lavoie. Of course, since there is money creation from banks, the true inflation drivers are not in money creation, but clearly in some other factors, cost push and profit pool. And also, as we insisted on with Matthias Grasselli, Say's law must be repealed in order to properly include endogenous money creation into a macroeconomic model. But this is not the point of my presentation here. It's just to revive the theory that you are aware of most surely. So this is basically what post-Keynesian has to say about finance. And in these models, and in the Godley-Lavoie book especially, you can see that there are models of asset price, but they are very, very raw, very frustrated. They are very simple because this is not the purpose of the book and of these models, because they focus mostly on the macroeconomic and they think about the real or monetary macroeconomic, but they don't think of financial markets as or their very fine behavior as something relevant. But for me, Hyman Minsky, it has partially an importance in the financial instability hypothesis. We have to acknowledge that. So, if you don't know the story, let me summarize it for you. So the story starts after a crisis that the economy is not in depression or very, very careful. Let's say very careful. And most people who are on the financial markets are hedgers, meaning that they are very risk averse and very reluctant in investing in new risky investments or emerging markets, because the past crisis is very vivid in their memory, and so they don't want to reproduce that immediately, and they want to secure returns. So what they want is to focus on past validated cash flows, so tangible cash flows that are on the past, and they just want to invest slowly in the economy. But with that, by doing properly their job like that, what happened is that the cash flows are validated and hedgers become more and more confident in the economy. And so somehow the speculators appear. Speculators, they take confidence. So we have to understand it as a institutionalist view. Huh? It's a convention. It's a class behavior that slowly changes over time, and the hedgers become less and less important, and let some place to the speculators who take on promises in boom, meaning that they now invest on promises. They invest on the anticipation of returns, and this anticipation of returns are not always grounded on validated past cash flows. And after that, there is this last actor, which is the Ponzi speculator. The Ponzi works the same as the speculators, but what they do is that they use the incredible boom in the economy or the financial markets and the increase, the high return on the market to make leverage, meaning that they use credit channels in order, say they borrow money in order to invest on the financial market, and they expect the returns to both refund the interest and the nominal on the credit, so that they actually they make an arbitrage, somehow an arbitrage. But by doing that, they create a systemic risk, because if the market turns down, then they can't refund their debt, because their liability is completely connected to the value of the assets, and they expect the value of the asset to go up all the time. And since they can make default, then they can generate a default propagation, because if they can refund their debt, then suddenly it depreciates the balance of the lender, and the lender also has to sell some assets in order to adjust its cash flows, and you have this let's say that's fire sale and effet boule de neige, this snowball effect. So this is the story of Minsky financial instability hypothesis. And what are the important features for Minsky is that first, it's a macro theory. It's a theory of macroeconomics. For Minsky, it was first the investment in real and tangible assets. It was depending on the debt ratio of firms who really produce. But most people want to update Minsky theory to financial market, because the global financial crisis of 2007-2008 was clearly something that was, of course, had macroeconomic grounds and foundations, but was somehow generated by the possibility to invest in special purpose vehicles and purely financial assets. With the asset-backed securities are of course yield priced, but still it was mostly generated by high speculation on the financial market. And Minsky financial instability hypothesis it's a narrative. It lacks analytical clarity, and people are sometimes disagree on the way to interpret this. Let's say there is an hermeneutic of Minsky financial instability hypothesis to accept, and so that many people suggest many different models of this hypothesis. Also for Minsky, financial markets has a positive effect on investment, on real investment, and on the economy, according to its two prices theory that I'm going to present to you very quickly. So the connection between the financial markets and the macroeconomic is the following. Usually people invoke Tobin's Q, which has been, let's say, mostly invoked by mainstream neoclassical economics, and which is very strongly connected to Minsky two prices theory. So here I divide the influence of financial markets regarding of the value of equity, or value of prices, and the yield, meaning that the dynamics and the returns of these assets. So in this first part, Minsky two price theory says that, well, when you compare the price of tangible assets, firms, machines, factories, plants, and the acquisition price, and you compare it to the market value of the companies, of your company, then it provides you incentives to, or not, to invest in the real economy. Tobin's Q theory is very elementary. You compare the market value of your company to your true acquisition price and the material value of your company, the material value. And if the market value is greater, then you have somehow leverage, because by making the acquisition of new machines, you increase the value of your company more easily than by because you have this Q is greater than 1. Minsky two price theory is basically the same. It just says that when the primary market, when new assets to buy is cheaper than old, when the asset prices are very high, then it's clearly interesting to invest in new assets, to emit new equity and to invest in new assets, a new water dam, a very new nuclear plant, and so on. It's cheaper than to buy existing assets. Buying existing assets, meaning, for example, making the acquisition of a new company, merging two companies, and so on. So the change in debt the investment will depend, because investment in the Goodwin-Klein model depends strongly on the change in debt, which is a mean to push forward the tangible investment. it can depend on the value of the asset prices on the financial market. A second aspect is that financial prices move a lot, and they move a lot and they can increase a lot. It's actually very impressive how high is the return rate of asset prices and equity prices compared to bonds and the GDP or the consumption rate. So that a high return of or high expected return of financial market prices will aspire the saving and money creation. People will think that there is here a very profitable investment in terms of financial investment, a very profitable investment. And this is calls for Richard Werner's quantitative theory of credit that I may develop for you if you want, which says that when you have new purchasing power, especially coming from money creation, you can decide either to put it in the real economy or in the financial sphere. And if the financial sphere is more profitable, then the money creation or savings that are already existing will be aspired to the financial markets. And Richard Werner tries to explain why the money creation did not have any inflation effect between the 80s and 2010 is because they are mostly most of the financial creation, the money creation was dedicated to buying already existing financial assets. If you can, especially if you include the housing sector. So clearly, the dynamics of the financial markets and the value of the prices are very important. They have a strong effect on the level of investments and the way of influencing the final finance and the dedication of your savings toward either real investment or purely financial investments. They also have secondary effects. For example, the equity holder powers are increased, and so it increases the dividend rates. And by increasing the dividend rates, it pushes the wages down. It sets the bar for the reinvestment. So it's something that I taught before. So there are many ways to see that financial markets has a strong influence on the real economy. Of course, there's a bad one also, is when markets crash. And when markets crash, for many reasons, but you can think mostly of a systemic default risk with the Ponzi speculator. Then what happens is that the credit channel shut down temporarily, that the central bank has to intervene exceptionally. And what mostly happens is that when there is an increased interest rate decided by the central bank, it impacts not only the financial sphere, which it comes from initially, but also the real investment sphere. So that the real economy is impacted, of course, by the risk aversion and the panic, which could be contained only on the financial markets. So it fragilizes the whole economy. Firms will bail out, you have increased employment, etc. So you know the crisis that you can have in the Goodwin-King model, the bad equilibrium. This is exactly what we think about. But in the Goodwin-King model, it is generated by explosion of debt, whereas in the economy, it can temporarily, or the intermediary would be the expression of a panic on the financial market after the explosion of debt. So as I said, there are many Minskian models of asset prices or pretended. You have macroeconomic models. So the post-Keynesian school has many sub-entities and sub-tribes like the Kaldorian, the Calexian, and here the Goodwin-King, but which I said that is not very faithful in representing the Minsky financial instability hypothesis. And there are also some people who attempted to represent Minsky hypothesis in asset prices model. But for the latter, so I at the end of my presentation, I have the full selective bibliography if you want to connect to these papers that are relevant. For this asset prices model, apart from a specific one from Rio, there's a strong disconnection between equity price dynamics and macroeconomics. It's a purely financial market model. And also in Rio, this dynamics is related to very long financial cycles, which would be coherent with Minsky theory. But the fact is that financial markets has also cycles that may be much shorter than what we expect to see in Minsky financial instability hypothesis, meaning that the instability can appear, or the variations of the market can appear on much shorter scales of time than Minsky was thinking of. Minsky was thinking of very long trends, and sometimes the instability and the panic can appear in very short time. So to precise my purpose, what I want to do is to provide an asset price model, a model of financial assets. And forgive me if I didn't mention, but I'm going to focus on the equity markets. Financial markets are very large. You have bonds and fixed income, you have commodities, you have currencies, and you have equity. And among all that, you have options and so on. I'm going to focus on the equity market, the market of the value of firms and banks ownership on the market. And so what I want to develop is a non-Minskian asset price model, something which is a little bit agnostic in terms of macroeconomic theory, a model that can faithfully represent what happens on the financial markets, with short-term instability and possibly accepting long-term trend movements. And I want to plug this model in a Minskian macroeconomic model, because Minsky theory was at first a macroeconomic theory. And so I simply want to give a financial market flavor to the already existing Goodwinkin Minsky model. Is that okay for everybody? I can go on? Okay. So which theory for financial markets? When you start studying financial markets, you are dogmatically repeated that financial markets are efficient, because financial markets are a very prototype of a pure market, a theoretical market. It's very transparent in terms of prices. It's very quick to information in terms of reaction. And people who work and live on these markets, they have well-defined purpose, which is to make money. And they have not contingent purposes like equity or social purposes. They just want to make money most of the time when they invest on the financial market. So it's like the prototype, the ideal prototype of market, and still financial markets are not efficient, or at least we have to understand efficiently in a very, very, very weak meaning. There are many, many ways to discuss that, but let me just simply say that you must absolutely see Jean-Philippe Bouchot's course at Collège de France on the complexity of economics and financial markets. It's a must-see on the state-of-the-art technologies that are applied to financial market, and it's clearly against this market efficiency. And actually is giving an extended version of this course at École Normale Supérieure the next month. So I think it's very, very, I strongly advise to look at the Jean-Philippe Bouchot's course and work. Actually, Jean-Philippe Bouchot is one of the author of the paper I'm going to explain later, as you will see. So how do financial asset prices behave on the financial markets? The fact is that it strongly depends on the time scale you consider. If you consider very short time scales, which is not very interesting for the macroeconomic scale, going from seconds to days, it's order book modeling. You just model how orders of buying and selling are coming into an order book, And this is now pretty, it's clearly engineering and mathematics. Now, which is nice is that these kind of models are micro-founded. They are, it's an engineering for optimal selling or optimal buying of assets to understand the liquidity of markets for people who trade. So it's really operational. And what is interesting is that one of the key tool that is used to model the micro foundations so the model they succeed in representing the dynamics of price by modeling the orders of buying and selling of anonymous people on the market. And what is a proof of inefficiency of markets is that the key tool to represent these orders are what they call Hawkes process, and Hawkes processes are processes that are self-stimulating, meaning that most of the orders that are coming on the financial markets, selling or buying orders, they strongly depend on the fact that people were buying or selling the second before. Hawkes processes were invented by Hawkes for representing earthquakes. And you know that right after an earthquake, there's a strong probability of having a second earthquake, which is exactly the same for financial markets. After someone makes a selling or buying order, people just react to that. So they are not reacting to economic information. They are just reacting to the financial market itself. So it's completely endogenous. Since it's endogenous, it means that the price itself is not reliable as a pure representative price of the value of the company. On the short term, which is really the main theory, so it goes from days to several months, is arbitrage pricing theory. And this is where people are more confident of expressing what they call market efficiency. It's a performative theory. Because arbitrage pricing theory is a portfolio allocation problem theory based on stochastic processes and mathematics, and it's based on optimization. And if you have the possibility of making free money, then the model will give you the possibility to make free money, so that it makes this arbitrage, this possibility to make free money, disappear, because especially there are a lot of people who are seeking for this arbitrage, and so the statistical efficiency appear because people have the tool and the mathematical tools in order to make it disappear. So it works, but it works only on very intermediary time scale between days and months, and it works only in good times. Only it works when it works, which is tautological. So it's a theory of good times, and it's a performative theory. On the long term, which goes from months to years, what you can see is that there is, as I said, an incredible high return rate of the financial markets and equity markets. And this has given birth to a problem which is called the equity premium puzzle, is how people cannot invest. Everybody should invest on the financial markets in equities, because the return is much higher than the bond market. And on the very long term, the risk is, I mean, you should be super risk averse in order for not investing in this market. To justify in terms of expected utility the fact to not invest on the financial market would be clearly to be super risk averse, which is not the case of people. People are not risk averse at this level. It has been shown so recently that by looking at 2 centuries of price series, trend following is something that is done, has already been done, and it should be done all the time. You should invest you should buy and wait for decades to have the best, the most profitable investment on the financial markets. But what makes it to temper this trend following movement justification, there is also a mean reverting. So trend following is basically you follow the trend you buy the asset when it rises and it's going to continue to raise, or you sell the asset when it's going to go down and you continue to go down. Mean reverting is the opposite effect, and I'm going to show you that in the model later. Mean reverting is that it's related to the inelastic market hypothesis. So to replace the efficient market hypothesis, Gabay and Koijen suggested an inelastic market hypothesis, saying that basically it's very difficult to assess what is the fundamental value of the companies, and that the asset prices, the equity prices, they just go around very elastically. They go around the fundamental value without really knowing it. So when the financial prices are too high, they are going to go down to adjust to the fundamental value, and if they are below the fundamental value, they are going to go up in order to readjust to it. And on the very long term, there is clearly the mean reverting process that you can show in the crashes. You have regular crashes at decade scales, and this belongs to the economic stories and monetary policies. And what you have is that when you have very, very high trends and very, very high returns for a long period of time, then people at some point, they suggest that the market follows a bubble, and people expect this bubble to crash. And when it crashes, you have a sudden reevaluation of assets, which is clearly a fall down. And when you take the average return of assets from one end of a crash to the next end of the crash, you have a return that is much lower, because you have this readjustment much lower than the average expected return when you take the whole history. So you have these very different dynamics depending on the scale, and this is you have to be picky and choose which is the most convenient for the model. For the Goodwinkin model, clearly, what we attempt to do is to focus on the fourth one, the last one, the very long term. But still, the third one, long term, should be relevant because, as I said, perhaps you will have some effect on the investment that are very local, depending on the fact that the model is over the fundamental value, or clearly overpricing the assets, or breaking down the investment when the equity price is lower than the fundamental value, whatever that means. And the fundamental value is something that is hidden. It's something that is not observable. Let's just mention two things that are very also interesting for the financial market that I want to memorize as a perhaps prediction for the final model. Since the model is not finished, I'm going to just mention them like that. Is the impact of investment on financial markets, the endogenous effect on the inflation. So Gabay and Kojigen say that investing $1 on the stock market increased the market aggregate value by about 5, meaning that there's clearly some self-stimulation inside the market itself. And Black says that there is this possibility of inelastic market hypothesis, but basically the markets are not efficient and prices are within a factor 2 of value. What he means by value is the fundamental value of the firms, so that basically they can be twice as much or half half of the value. So it moves like that. It moves around this fundamental value, which is not very well known, but it's a permanent tâtonnement process of the financial market. Okay, so what do I want to keep for my model? I want to keep this inelastic market hypothesis. I want to get rid of the efficient market hypothesis. The financial market will not reflect the tangible value of assets or expectations, if expectations are perfect, but in post-Keynesian models, we don't have such expectations of future cash flows, which are fundamentally uncertain. So we expect the financial asset prices to make large movements, and these movements will be, I want them to be not deterministic. They be hidden by noise. We are not sure that you're on a trend. Perhaps it's the noise, perhaps it's the randomness. You're never sure of what you're looking at. Are you looking at the trend? Are you looking at the noise? Are you looking at the bubble? You're never sure on the market. But still, it's going to be structured around a fundamental value, because if I want to connect the financial market to the real economy, I want the real economy to provide strong signals for the financial market, especially the firm value in terms of tangible capital and profits, for example. There will be mostly input for the financial market model. And I like this idea of having micro time foundations, meaning that if I still want to focus on the long or the very long term because it's the purpose of the macroeconomic model, but I still want to generate short-term fluctuations that perhaps will provoke a financial crisis, like in probabilities or depending on the path. You know, sometimes it's just a small event that generates, makes the bubble explode because the system was vulnerable, but it just generates the little, it ignites the crisis. So I want smart short-term fluctuations in order to allow for that. Of course, I want to take into account monetary regimes, macroeconomic regimes. So I want all these things to plug in the model, which is not yet done, but I'm going to suggest the way to do that. And of course, I want to introduce the possibility to have slow structural change on the financial markets, especially going from hedge finance, people who are very risk averse, who want to only invest in solid cash flows, towards speculative and even Ponzi finance, with the possibility perhaps to have financial crisis. So of course, the model will be with no rational expectation whatsoever, or boundedly rational, or adaptative expectations. And it's going to be a true endogenous dynamics with instability, or at least with fluctuations. I don't expect the model to be stationary or around the equilibrium, like at the equilibrium. Okay, so now let me present the model that I picked up, that I found as a very good candidate to do that. It's not mine. The first version was given by Chiarella, and I'm going to provide the latest version by Bouchot and Majewski. So the idea was taken from Beja and Goldman from the 80s. You consider two populations of people on the financial markets. So you assume there's only one asset. For simplification, there is only one asset. And there are two people, two populations, two kinds of people. And these kind of people are fundamentalists or chartists. The fundamentalists, they focused on a presumed fundamental value VT. So they have their own machinery to compute this fundamental value. They look at the macroeconomic variables. They are macro investors. And they need a they need a fundamental value belief or a construction. And we will see how to provide that. So in the idea, they are very similar to hedge investors because they don't want to invest in an asset that is over a true tangible value, but it's not related to past cash flows. It's really related to the present value, but the present value can be potentially represented by past cash flows in the macroeconomic model. For chartists, people who are trend followers. These trend followers, they look at a proxy process, which is called M, which M will be the trend. And they look at this trend, which is a construction based on the financial asset price. And according to this trend, they will decide if they want to follow the trend. And the trend can be, of course, an upraising trend, a trend of increasing prices, or a downtrending. And for that, they need a trend detection model, which is going to be very simple. It's going to be an exponential moving average. So it's basically going to be un lissage. It's going to be smoothing the asset price. And in the idea, in this model, they are very similar to speculative investors because they don't care about the fundamental value whatsoever. They only care about the dynamics of the price. Whatever the value, they just care about the dynamics of the price. And later, so Majewski and al will introduce the noise traders because they want to introduce the stochasticity in the model in order to more faithfully represent the erratic movements of prices on the markets, and also to I have in mind the work of Florent Maquisac on estimation with the maximum likelihood. They want to also have a stochastic model in order to make a maximum likelihood estimation after that. So it's not a deterministic model that they want to calibrate. It's a stochastic model that they want to estimate with the time series. So the design of the market is very complex. It's absolutely not a Walrasian auction. There's no equilibrium price. The price and the dynamics, they will impact the excess demand, meaning that there is a demand for fundamentalist and chartist will depend on the value of the price or the dynamics of the price. And the dynamics of the price, so this is the log, this is the return, the return of the price, P. It will basically be proportional to the excess demand. Excess demand meaning that there is a wave of people wanting to buy if D is positive, and there's a strong wave of people wanting to sell if D is negative. Okay, so this is called the excess market demand for the asset, and this is the price is moving according to this demand. So this is an instantaneous demand. Okay. If you have any question, you tell me. The demand is splitted between the fundamentalist and the chartist and the noise traders. So the fundamentalist is basically a linear demand, and it's an elastic demand around the fundamental value V, meaning that when the fundamental value is greater than the market price, the fundamentalists will buy the asset. This is going to be positive. And the larger the gap, the more they are supposed to ask for it, because they think that the price will adjust to the fundamental value, so the price will increase. But when the price is above the fundamental value, they sell the asset because they think that the price will decrease to adjust to the fundamental value again. And they think that the fundamental value is the long-term adjustment of the market price. For chartists, they have a demand function. And this demand function will be a function of one variable, which is M, which is the trend, which is the construction of the trend. And the trend in the model is basically an autoregressive process that takes the exponential moving average of the return of the asset. Meaning that if the past returns have been positive for a certain window frame of time, then they think that the return will be again positive for the forthcoming days or months or weeks. And if the return is negative for the past weeks, then they think that the return will be a negative also for let's say the next week or the 2 or 3 next weeks. And so by looking at this M is the smooth return, average return of the price, and it depends only on the log price. You see, this is the log price, the variation of the log price. And so the demand of chartist is simply a demand function, a monotonic demand function bounded of this trend. Okay? And in addition to that, Majewski and Bouchot, but Carella also suggested that there is noise trading. Noise trading is just people or the acceptance that on the financial market, there are many buying and selling orders that are contingent to you suddenly have a legacy, you suddenly need money to buy a car, so you just get rid of your investment. There are many external reasons for buying and selling, and this will provide the noise. There's not only the great trends of buying and selling of the 2 first populations, there's also this little noise. The noise trading is just people who buy and sell for no apparent reasons or no coherent reasons at the scale of the market. But of course, people have legitimate motivations for doing that, but you don't know that. It's anonymous.
Adrien, can we hear us?
Wait. Yes.
So just on this question of the noise traders, I guess you agree that actually they are not Brownian.
So they are non-Brownian. So yes, if you look at the micro scale, if you look at the very micro scale, they are non-Brownian. Meaning that if you look at seconds, minutes, hours, and days, clearly it's non-Brownian. If you look at weeks and months, you will see that it's Brownian, but you need a stochastic volatility meaning that you need this sigma itself to be stochastic in order to have fat tails, because the agitation will have an impact on the noise trading itself, meaning that when of course this sigma will be noisy and correlated to this Brownian motion Wn. So it generates a non-Gaussian distribution. Clearly, it's a non-Gaussian fat tails distribution. I think today we have pretty realistic models of the stochastic models of the time series, and they use the Gaussian, but not only. They use a Brownian motion for the asset, and they use a fractional Brownian motion for the volatility. The volatility is rough. It's a phenomenon, but now which is very precisely represented, very well represented. So in the aggregates, yes, you can say that it's non-Brownian. It's the Brownian motion is too simplistic, but I would say that you would need to augment the dimension of the model in order to have something more accurate, and not switch the Brownian motion by some other stochastic process. I would avoid getting rid of the Brownian motion in order to have a jump process. I would rather prefer extending the model to have it more complex and have a stochastic volatility which is rough in order to be very, very accurate.
Okay, thank you.
So the model boils down to that. You have the change of price, the change of the log price. I mean, we focus on the log price. It's always more interesting to look at the return of the asset price. So it's I look at the demand of fundamentalists. I take also the log price here also instead of the price. This does not make any difference. Sorry. So it's a linear function of the difference between the fundamental value and the asset price for the fundamentalist. It's this demand function of the trend for chartist, and you add the Brownian noise. And for the trend, you have what I suggested before. DMT is equal to this autoregressive process that takes the price as the innovation, the log price as the innovation. And what Majewski and al add to the Chiarella model, Chiarella as a special case of this model when the fundamental value V is constant. It's just something that is given. The model is not focusing on the dynamics of the fundamental value itself. So it assumes a constant fundamental value and no randomness. And Majewski et al, they suggest that perhaps the fundamental value could be another process, something that is dynamic, and that I expect to change when I plug it with a Goodwin-Kidd model. The fundamental value will be given by the dynamics of the tangible capital of the firm or the bank, meaning that the equity price, the equity fundamental value of the firm is basically given by its capital, or perhaps a function of its capital and its profit level, because people are mostly looking at expectations of profits in the value of the capital. So this V would be changed for something else. This is this process is here. It's arithmetic Brownian motion with a trend, a growth rate, which is G. Okay, so let's look at the dynamics of such a model. So let's start with the Chiarella model. The Chiarella model is a deterministic one. You assume that there's a constant fundamental value and you have no noise traders. And by doing that, you obtain a linear equation, which is a generalization of van der Pol oscillator. And this model, it's standard to show that it can produce a unique stable limit cycle. So in M dot, in the dynamics of the trend, according to a given criterion here, which is, I'm going to explain right now. So basically, if kappa is below alpha times gamma beta minus 1, so let me recall that kappa is the strength of the fundamentalist, beta is the strength of the chartist, and alpha is let's say the discounting rate of the autoregressive process. When alpha is very high, it's very slow trend process when alpha is very when alpha is very low. M is almost constant. It moves very slowly because it takes very adjustments of the innovation. When alpha is high, it takes mostly the innovation. If alpha is equal to 1, it's basically taking the focusing on the present. And when alpha is close to 0, it's focused on the whole past history of the price. So alpha is let's say the reactiveness of the chartist. So alpha will have an impact on alpha, beta, and gamma will have an impact on the power of chartists, and kappa is related to fundamentalists. So when fundamentalists are, let's say when chartists are sufficiently strong compared to the fundamentalists, then you have a unique stable limit cycle. And when you have the contrary, what you have is that you have convergence to the equilibrium, meaning that the fundamentalists are too strong and that they adjust very quickly to the fundamental value. And so the price process converges to the fundamental value. So basically you have this very easy criterion that provides two dynamics. So this is the phase the phase map here. You can see that starting from an initial value, when you have repulsive first, meaning that when kappa is below the threshold given previously, you're going to converge toward the cycle. And this cycle is basically saying that, so the interpretation in terms of the extensive variable is that the price of the asset will go above and below the fundamental value, and it will fluctuate around this fundamental value, which is constant in the Carré-La model. So basically, the chartist and the fundamentalist, they play with each other, and the price fluctuates permanently. Now it converges toward a limit cycle. So you can see this kind of dynamics that you may know of, because this kind of stuff that you obtain in the Goodwin model, for example, and this kind of cycles. So as I said, if kappa is greater than this formula here, fundamentalists are strong and prices relax toward the fundamental equilibrium value. Otherwise, there are stable limit cycles. But let me insist on that, the model does not allow for explosion or collapse. It's just either it goes towards the equilibrium or it produces cycles. Okay? So there's no possibility of collapse here, and it's okay. It's okay because it's not something I want now. I want a generic model of assets, and perhaps the explosion or the collapse can be brought by introducing long-term dynamics with speculators and Ponzi finance. The stochastic case is given by Majewski and al. And what they do is that you see that this kind of erratic movements that are produced thanks to the Brownian motion, this is actually what you see, the difference between, so this is the trend. The trend is moving like that around and above. It's sometimes positive, sometimes negative. And you can see something similar for the difference between price and fundamental value. And so what they say is that basically this model is, of course, not explicit anymore when you have a Brownian motion included in the dynamics. It's not something that you can analytically study as easily as the Carré-La model. But what Carré-La and co-authors do is that they study pathwise bifurcation and distribution bifurcation. And what they show is that, so they look at the distribution, asymptotic stationary distribution, and they show that the same condition that we have seen will generate either a unimodal distribution or a bimodal distribution, which is absolutely coherent with what we've said before. A unimodal distribution is a distribution that has only one mode, which is basically when the price converges towards the equilibrium. And the bimodal distribution is suggested by the fact that the price will move above and below the fundamental value all the time, so that there are basically two modes, one above and one below the fundamental value. So the stochasticity will not change this fundamental property of the Carré-La model, which is very, very, very nice characteristic. what Majewski and Al do with this model is that they improve it in order to fit a little bit more to the financial data they have, because Jean-Philippe Bouchot is an empiricist of financial markets. And what he shows is that the values of kappa estimated in the model imply a unimodal distribution, which is strange because when you look in a fine way the distribution of real asset price returns, you obtain somehow, it's very hidden at some point, you obtain bimodal distribution. You obtain something which is bimodal. Other questions that are raised by Majewski and I is that, okay, you rely on a fundamental value, but what is the fundamental value? It's not something that we have an easy definition of. And so what they do is that they make an econometric estimation based on Kalman filtering in order to suggest that the fundamental value is a hidden process that fundamentalists try to seek behind the price. And it works. And after doing that, they show that, interestingly, the demand for both the trend and for the value effects, so for fundamentalists and for chartists, is not, for chartists, it's not monotonic. It has a very cubic effect that you can observe here. And for the fundamentalist, it's not linear. What is in the model, it suggests that it's linear, but it should not be according to the data. And they have a suggestion of function, extended function for the fundamentalist, which is a cubic function for the demand. And this is very intuitive because when you don't know the fundamental value, because it's not something that is objectively given by the market, when the price is supposedly close to it, it's very difficult to know if it's above or below. It's very fuzzy. So according to uncertainty, the demand would be very flat, close to the equilibrium. But the more away you are, the more confident you are that the price is away from the fundamental value. You're not sure what is the fundamental value, but you're sure that it's wrong. You're sure that it's below, you're sure that it's above. So this nonlinear demand is something which is much more realistic for fundamentalists. And what they show, I'm going to go quickly on that because I want to perhaps give some words on the connection with the Goodwin-Keene. What they show is that with this nonlinear demand function, you re-obtain the bimodal distribution of returns that is observed in the reality, and you can estimate a hidden fundamental value, which is consistent with what I suggest from Black and a model from Gordon, saying it's basically something which is a smoothing of the prices, and the price can be twice as much or twice less than the fundamental value in this hidden fundamental value that you can construct. Okay. So this is the bimodal distribution that you can obtain for the price distortion, for the price distortion. Okay. So let's just summarize this model. This model is very interesting. I mean, I think it's a simple model that can be that use the same tools that we use mostly, apart from the Brownian nose, the same tools that are used for the Goodwin-Keene. But the problem is that it's a purely phenomenological model. Sorry, it has no quantities whatsoever. There is no money. There's no amount of money. There's no amount of equity, and it's absolutely not stock flow consistent. There is also in this model a simple model of fundamental value that is exogenous, and we would like to include to switch this for a more fluctuating, more diverse, and more complex model of the fundamental value, which could be based on the Goodwin-Keene model. And also, as I said, it's a model, it's a structurally stable model of markets. There is no crash, there is no explosion. So it's just that the prices, they fluctuate around a fundamental value.
Adrien,
So, well,
yeah, what do you mean when you say there is no quantities?
in this model, when you look at the basic equation here,
yeah,
you have just a demand, excess demand, and you don't know what grounds this demand. You don't know what is the purchasing power of the population. You don't know what is the size of this population. You don't know how it affects their balance sheets. you don't know if they have the budget to buy the asset or sell the budget. Okay. And most importantly, there is an excess demand, so they buy or sell the assets all together, but they buy it from who? Because when you are stock flow consistent, a transaction means two counterparts, and you must buy it to someone. So it's clearly just a phenomenological model. It's just explaining the movements, but it's not explaining on which ground, economically, on which actors these movements are built. You see what I mean?
Yeah, sure. By the way, I have another question for you that I wanted to ask earlier. Which you say that they look at the asymptotic invariant distribution.
Yeah, stationary distribution, yeah.
Stationary distribution, yes. You mean when we take the volatility going to zero in front of the Brownian motions, or what do you mean?
No. It means that so even if you have a limit cycles for the deterministic model, you have some complex stochastic dynamics.
Yeah.
And this dynamics is somehow it's not stationary in the sense that it's an ergodic process with a stable distribution. It's just that there is you have a convergence to the distribution of certain periodic size of paths. So you take paths that makes an orbit. You know, I had a paper on this kind of orbits, stochastic orbits. And basically, you take a closed, this kind of suggested closed orbits when the stochastic model has made this cycle. And you look at these cycles, and these cycles, they represent, on the asymptotic, they represent some stationary distribution, which is something which is a little bit complex to represent in two-dimension because it's distribution on paths and not on the returns. But if you project this on the returns, on the immediate returns, you obtain this bimodal distribution.
But
you see what I mean?
Sorry to ask you this question. So how do you get rid of the Brownian motions?
You don't get rid of the Brownian motion. The Brownian motion is always here. It's actually the Brownian motion that generates, it's a Gaussian, the Brownian motion, and the system is a transformation of this Gaussian distribution into another distribution asymptotically.
Okay. Thank you.
So what I want to do with this model is connect VT to capital and profits as a fundamental value, relate kappa and alpha and beta to monetary purchasing power, and allow for possibly money injection and fire sales, meaning that sometimes people make credit in order to invest on the financial markets. This is what do the Ponzi speculators. So what is the connection we want to do? We want to do the connection with somehow a version of the Goodwinkin model. And the requisite would be to have uncoupled savings consumption choices, as you have in the Gracili and Nguyen model or in the recent Dossetto and Giraud. And you need also to notice for equity. You need in the balance sheets to have the existence of equity. So you need an equity market. And you have that in the balance sheet of Dossetto and Giraud. This is actually, I'm taking it from Dossetto and Giraud. What you can see is that what I would need for the model as input is the quantity of money. So the deposit here, perhaps we'll use, of course, for consumption and so on. But let's say that you have some net savings on the deposit and you want to invest in equity, which is E. So the households will basically have changes in deposits and firms' equity. So they will have a portfolio allocation. It will depend on the profit of the company, but the fundamental value will depend on the profit of the company. It will depend on the dynamics of capital or the value of capital. So basically, these are all inputs for the model. And as output, you will have the value of E, which is not represented here because there is a different value for the equity and the price of the capital. The asset price will be a different value. And you will also have perhaps impact on the dividends of the dividends for the owner of the equity. On the other side, my SFC stock flow consistent table will be very simple. You will have fundamentalist and chartist. And in order to be sure that I have a stock flow consistent model, which is still open because it's going to be open to money coming from the economy, but I want the trade transactions to be coherent, and I will introduce a market maker, meaning that actually fundamentalists and chartists, they buy and sell to and from a market maker. And this is a nice way to make the distinction between in the way that the market is designed, the demand is price taking. Fundamentalists and chartists, they take the price as given and they compare the price to the fundamental value, or they look at the dynamics of the trend of the price, and that defines their demand. But for the market maker, it's the contrary. It takes the demand of the fundamentalists and chartists as given. It answers the market makers that answer necessarily to fundamentalists and chartists, but in return, they change the price. This is what market makers actually do. So they change the price, and the change of price is exactly the model of Chiarella and Majewski and al. And of course, you have exogenous demand at any price for the noise traders, because noise traders, they buy and sell for reasons which are not related to the price itself or the demand. So the market maker I introduced ensure the stock flow consistency, and it's very easy here. All this population, they will have cash and equity. They will have a riskless asset and a risky asset. And basically, what I want to represent is a model of self-finance portfolios. Of course, afterward, I can inject money from the economy or extract consumptions from the portfolios. But basically, at first, these portfolios will be self-financed because it's only trading between cash and the equity. And the fundamentalist will basically sell if the price is greater than V, buy if the price is lower than V. And the chartists will do depending on the M. They buy if the dynamics of the price is greater than 0, and they will sell if the dynamics of the price is lower than 0. So they both have a very easy long-short strategy, which is basically buying and selling. I can actually develop, but perhaps I can leave that for questions, develop the micro foundations of the model in order to justify how a simple buy and hold or buying and selling strategies, these long and short strategies, can generate the demand functions on a heterogeneous population. And actually plug into this demand function the feedback that are very needed in order to ensure that the quantity of money that the populations hold will have an effect on their purchasing. Because if they don't have enough money to buy 1 unit of the asset, they need to buy a quantity of asset which corresponds to their purchasing power. So the quantity of cash and the value of equity will be related in order to adjust the demand function. It is something which is very important. You can't just assume that the demand comes out of nowhere. The demand must be adjusted depending on the purchasing power of, in terms of saving, of course, the purchasing powers of the investors. Let me perhaps conclude, let's say, open the discussion and the work to be done, because the stock flow consistency has been done, the equation has been written. What I want to do with this model is to consider this financial market model as an intermediary. You have investment banks, hedge fund intermediary that takes the savings of households, firms, and banks and put all this money into either cash or equity. And this self-finance portfolio will be decided, partly will be fundamentalist, a part will be chartist, and perhaps at some point, some will be a Ponzi, which are chartists on the appraising trend, bull chartists, bullish in bullish market, by using debt creation, money creation. And I'm sorry, I couldn't show you the plugging with Goodwinkin model, but the thing is that when you plug this to model, you have a very, very complex dynamics. And the question is to go in several steps. First, to show how the Goodwinkin model will impact the financial market, which is my main purpose at first. But in the second step, what we want to show is that the financial market itself can have an impact on the macroeconomic, which is much more relevant for the macroeconomic questions that you may ask at the Georgetown Environmental Justice Program. Anyway, this the road is paved of a lot of tasks that are not finished yet. but I would be delighted to exchange with you and make this work more extended with you if you are interested in it. I'm going to finish that and perhaps leave time for the questions.
Yep.
Thank you.
Thank you very much. So we are kind of running out of time, but we still have, I think, 5 to 10 minutes for questions.
Let me just 1 minute. Let me just put the light on because you can't see absolutely nothing.
Sure.
It's nice.
Yeah. No very mysterious.
Much better.
So as usual, we can go for questions of online participants first. So is there any question from those that are only online?
So maybe yes, if you can hear me.
Yes.
Yes.
Yes. So thank you very much for the presentation. I understand that it's you are currently working on this, but I'm just wondering what kind of effect do you expect from the financial to the macroeconomic model? Because I understand that the Goodwin-King model as it is not a Minsky model. Now you add a kind of financial market model, but at the same time, the elements which could bridge the gap between financial crisis and the macro crisis are not in the model neither, because there is no interest rate, or at least not an endogenous interest rate, and at the same time, there is no link between the equity and the debt system. So I was wondering what kind of link could you expect, at least theoretically?
Okay, so at first,
I think.
I think.
Sorry. I was let's get back to that. So the first thing to do is, of course, to introduce the interest rate, and the interest rate will be necessary in order to have, in particular, to see the profitability of equity relatively to the bond market. But also, it will be important for the Ponzi speculator, because this gap, this difference of the profitability between the equity market and the bond market, will be the main motivations for Ponzi speculators to appear. So that when you have Ponzi speculators, what they will do is that they will create debt, and they will indebt themselves in order to buy some assets and stimulate the price dynamics. Since the price dynamics will be stochastic and there will be in inner fluctuations, it may be possible that the Ponzi speculators asymmetrically will behave very differently when the price goes down, and they will have to fire sell the assets. And by doing that, if their balance sheet is not equilibrated by the selling, they make default, and by making default, they spread the default to the economy. So how to express that in the model? I would say that the interest rate could be reactive to this kind of default. And if you have default, the interest rate would be augmented, raised by the monetary policies or the banks. So that when the interest rates rises, then suddenly it rises for the whole economy. So one of the first things that it would do is that it would increase the interest rates for the whole economy, not only the financial market, but for the real economy. Secondly, when you decrease consistently the equity price value of the company, you may have firms bailing out, and you may have a decrease in the capital, meaning that you have to sell tangible capital in order to refund the debt. And so it can have an influence on the investment function that is used in the Goodwin-King model, and you may have a decrease or a collapse in the investment, actually a divestment in this case.
So we also have a question from Alejandro, who's in the train, so he cannot speak. And it was just asking if this module could be included in a computable general equilibrium model, because it's one of the weaknesses of those models that they don't usually include financial markets.
I really don't see how at first, but I'm not saying that it's impossible. I'm just saying I don't know how. But clearly, these kind of models I present are more suitable and have a counterpart, not for CGEs, but for agent-based models. Agent-based models in econophysics and modeling of financial markets are very strongly connected to the models, the Carrera model I presented to you. And so there is a definitive, I would say, promising approach by perhaps not connecting it to a CGE, which is perhaps possible, but clearly to an agent-based model of the macroeconomy. Yeah.
Okay, thank you. Is there any other question online? So I think we might just have time for like one additional question in the room. I don't know which one of you.
It's a question about especially this agent-based model side, which is on a Goodwin-Kin model, we have one aggregated household, and typically you've shown that for a model to run, you need at least 3 classes of investor on the market with 3 different behavior. So how do you think like you should disaggregate households into like those 3 classes with each a theory of consumption behind? Or do you like plug it to the general shareholding and we recommend that?
I think I understand you. You tell me, I'm going to answer. You tell me if I understand correctly your question. So in the Goodwin-Kin model, you have households, firms, and banks. And perhaps they can all say, but clearly you need a finer model of investors if you want something that is representative of what I've done. What I suggested, of course, too quickly at the end of my presentation is that you should invoke an intermediary. What people do is that everybody puts his money in the bank or the pension fund for the retirement plan or so whatsoever. And this is the traders at the retirement place that are different populations. So what they do, what I suggest is that to take all the money that is saved, all the money of all the agents possibly, or all the money, the agent that saves some money, and this money will be invested on the financial market thanks to an intermediary. And this intermediary will split between fundamentalists and chartists. And this split of fundamentalists and chartists will not depend on the intermediary itself because it's more depending on the historical convention, but it would depend on the historicity of the model. For example, I would say nowadays people are more speculative, but clearly if a financial market breaks down in the year, next year, they are going to be a little bit more edge. You see what I mean? So I think that the size of this population could be also given endogenously. But at first, let's fix the proportion of hedgers and speculators and make it just depend on the way financial markets are at the present.
Just a very quick naive question, perhaps I don't understand, but you talk about different time scales, the short terms, the
yes.
very short, so on and so on. And it's not clear for me how this type of time, of how this reaction are mixed in the same model, because
they don't.
They don't, okay.
They don't. At least the first 2, meaning that between the seconds or nanoseconds for some financial markets, high frequency and arbitrage, they don't fit in this model because they are based on efficiency and operationality. This kind of time scale are dedicated to agents and operations. It's purely engineering. For economists, what is relevant is the 3rd and the 4th one, meaning that at the scale of months, years, and decades. And so what I want, what the model suggests is to represent noise and dynamics of prices that are fluctuating around fundamental value, but it's something that does not make any sense at the scale of seconds or days. So I'm just focusing on the two last scales of time.
Thank you very much. So I think it's time now, so we'll probably end the seminar here. Thank you again for all those who attended, and thank you, Professor, for presenting today.
Thank you. And if you want, I can share my slides, send you my slides later.
Yes. Yeah, with pleasure. Thank you very much.
You're welcome.
Gael had to leave to give a class, but
don't worry, I'm going to catch him. Don't worry, I'm going to catch him. Okay, thank you very much. See you around.
Yes, thank you very much. Bye.
Thank you.
Bye-bye.